Well, hello and welcome to Money Matters. I'm your host, Kimberly Lim. Coming up in today's show, why luxury goods retailers may have to downsize to survive in a harsh new economic climate. How online shopping put paid to the iconic Toys R Us store in New York's Times Square. And later in the show, a record year at the box office. Hollywood fights off fierce competition from small screen rivals like Netflix and Amazon, ending the year on a high. Well, all that's still to come, but first let's catch up on some of the day's top business stories making headlines. Microsoft says it will warn service users when they suspect a government has tried to hack their accounts. The policy comes in just 9 days after the news agency Reuters asked the company why it had failed to tell victims of a hacking campaign that had targeted Hotmail accounts owned by China's Tibetan minorities. The policy shift follows similar moves by Facebook and Twitter. Shares in Weight Watchers soared 19% after the company launched an advertising campaign featuring Oprah Winfrey. The TV host talked of her battle with her weight during the emotional 1-minute ad, which was shown in the US on Wednesday. Winfrey bought a $43 million stake in the company in October. Shares in the dieting firm have tripled in value since Winfrey bought in. And a Japanese state-backed fund will help Toshiba rebuild its home electronics division and other operations by pushing tie-ups with Sharp. That's according to the Nikkei. Toshiba is looking to merge its white goods segment with its counterpart at Sharp. Toshiba needs to restructure its business after a $1.3 billion accounting scandal and recently asked for more funds to help on that front. Now, 2015 was a pretty tough year all in all for the luxury goods industry, mostly because, of course, of the slowdown in the Chinese economy and the crackdown on corruption there. So where has that left the industry as it heads into a very uncertain 2016? Well, to tell us, we're joined here by TRT World reporter Sarah Morris. Sarah, many thanks for joining us. So what's really gone wrong then for luxury brands?
Well, as you said there, the China slowdown. China has been the holy grail for luxury brands for so many years, about a decade now. And the problem is there's just no cash to splash. But when you take away the problem of the slowdown, what you're left with is these luxury brands that are just way too overexposed. So they went on this really aggressive growth program between 2008 and 2011 particularly. I think 42% of new luxury brand stores were opened in Asia compared to 5% in, say, North America. So they went hard. Burberry tripled their number of stores in China. Prada doubled the number of stores in China. So now we've got to this point where people aren't buying anymore, and these stores have all these shop fronts, which are so expensive to run between rents and staff wages, and, you know, they don't, I guess, go easy on the displays, do they? They're luxurious and they're beautiful and they cost a lot. So here they are with all these stores and no one buying.
Okay, so what's the answer then? If you're a luxury brand, what do you do right now?
Well, I guess you've got to pare back a little. You've got to get rid of some of those stores. But the experts are saying there's some other options too. The luxury brands have been really hesitant to get onto the online shopping world, and they need to do it, particularly in Asia, where they're really, really keen to online shop. And the other thing they could possibly do is try and branch out a little bit, value add. So the luxury product perhaps stops being the main event of a luxury brand now, and you've got to perhaps find a way to get it to someone within 12 hours or 3 hours. You know, perhaps it's something that's difficult to get, or get it to them. Find ways that people will spend their money or spend a little bit more than they would at the shops.
Okay, Sarah, many thanks. We'll leave it there. Right, to an altogether different level of the retail experience now. The rise of online shopping has claimed yet another victim, this time the iconic Toys R Us store on New York's Times Square. The store, certainly a favourite destination for out-of-towners, serves its last customer today. It's been forced to close down as rent costs soar and consumers change their shopping habits. Shatia Brantley reports.
Toys R Us's flagship Times Square store has been a must-do destination for many tourists, but that ends today after the retailer chose not to renew its lease for 2016.
I think it's unfortunate. We love to come here every time we come to the city. We've driven here several times just to take our kids to the biggest toy store in the country. It's always a memorable time, and so we made the trip from Massachusetts this morning, left at 4:30, just to get here and celebrate the last day with them.
Toys R Us has been located in this Times Square location since 2001. Its Ferris wheel and other attractions were a big draw, but the changing toy retail landscape made escalating rent prices tougher to bear. It joins FAO Schwarz, which recently shuttered its Midtown location earlier this year. Retail analyst Mary Epner says we can expect to see more retailers do the same.
I think if they don't have differentiated product, then yes, I expect to see it. If you're just competing on price, then that means you need to sell more in order to make up for that higher rent and higher minimum wages. So for example, since the end of 2008, the Times Square rent is up by 2.5 times for retail space.
This comes as the consumer shift to e-commerce sites such as Amazon continues to grow. Toys R Us said it is searching for another Midtown Manhattan location.
Well, time now to take a look at the wider economy. And bank after central bank eased rates or pumped stimulus into the economy this year, over 40 of them in a bid, of course, to boost growth, fight deflation, or indeed a bit of both. Now, the results, though, are pretty questionable, with many investors asking whether 2016 will be the year when ultra-loose monetary policy is seen to reach the limits of its potential. David Pollard has more.
European Central Bank, December 3rd.
40 banks and more have eased over 12 months, many repeatedly. This a roll call of honour for those doing battle against a determined enemy, low growth. Though all the easing in the world hasn't made things that much easier for struggling economies.
We're now in a situation where most of the global economies have pretty close to zero interest rates. And we're now discovering that although zero interest rates sound like a very good thing, it is not generating growth, it's not creating employment, and it's not causing economies to expand. Central banks have to find a way of making themselves relevant.
For Bill Blaine of Mint Partners and others in the markets, low to no inflation is, it seems, becoming a permanent feature. Deflation a lurking danger. Cheap money flooding into the markets has, it said, been good for corporates enjoying a massive M&A spree or for a fashion of returning cash to shareholders. But little else, and as China slows, the world's other dominant player also has risks. CMC Markets' Jasper Lawler.
The great white hope is the US, but that's definitely got its problems. The US recovery has been one of the slowest on record after a recession, and they are looking at raising interest rates. So that can actually hamper and maybe even top off this recovery just as it's kicking into gear.
Time perhaps, says Panmure Gordon, Simon French, for the global political elite to be given a reminder from an out-of-fashion textbook.
They have forgotten the lessons of the 1930s and what Keynes taught us about fiscal expansion and stimulus, closing the output gap in situations where there's a chronic lack of demand. And given that all the onus has therefore been put on monetary policy, they've had to keep it rock bottom and indeed move into negative interest rate territory.
2015, the year of the great rates debate. The concluding word for now going to Janet Yellen. But it's not over yet. 2016, likely to see this list get even longer.
Well, joining me now to discuss all that is Nick Beecroft, founder and CEO of HP Economics. Nick, first of all, thanks for joining us. Let's talk a little bit about what we saw in that package there, all that cheap money flooding into the global economy this year. The results still a little bit questionable. I mean, what are your thoughts? Was it necessary or money down the drain?
Necessary, certainly, and I think it's now really undeniable to observe that QE has worked. I don't think economists really know why it's worked or how it's worked, but I think it's undeniable the fact that it has worked in most of the major economies in which it's been implemented. So the question now is, has there been too much, I suspect? And given that economists are somewhat in the dark about how it's worked, there also, I think, that worries will arise this year as to whether there has been too much and inflation may be overstoked, so to speak, down the road.
Let's talk about that US interest rate, raising rates for the first time in some 9 years or so. I mean, what's your thought? Was it the right time for that move or possibly too soon?
I think it was the right time, quite frankly, because I think the risks, if anything, this year, which will be a surprise to the markets, are on the upside for inflation. I think we're seeing already quite large wage growth coming through on private surveys of wage growth, often in contrast to the to the official, if you like, government surveys, such as the Bureau of Labor Statistics in America. So I think, if anything, inflation could surprise the upside, and the Fed could be chasing its tail somewhat as the year goes on and raising rates more than people expect. So it's a good job that they've started already.
Because that's certainly something that's made the markets very nervous. I mean, everyone expected the December move from the Fed, but it's a bit uncertain as to how fast or what they're going to do over the next coming months.
Yeah.
How do you see the Fed progressing as we go into 2016?
Yeah, well, despite the emollient words that Janet Yellen's always careful to use, saying that rate increases will be slow, I think inflation figures will start to show a heartbeat, if you like, by the time the Fed meets in March. And the market at the moment is looking at a 50-50 probability that they raise rates in March. I think it's more like 70% probability that they do so. And so then the market will readjust its expected path for the increase in rates. And I think that'll become more like 1% over the coming year as opposed to 50 basis points at the moment.
All right, Nick, we'll leave it there for now, but stay with us. Okay, plenty more here to come on Money Matters. Coming up, how 2015 was a stellar year for the movies at the box office, and 2016 could be the same. Now, many investors feel pretty battered and bruised after a volatile and somewhat unpredictable 2015. Experts say market indexes have gone up and down between 20 to 25%. Now, slowing growth in China, of course, the debt crisis over in Greece, and strong volatility in world equity markets have left many wondering where to stash their investment dollars. Now, what will the world bring for investors in stocks and shares in 2016? TRT World reporter Chitra Norbat tries to find out.
Be prepared for surprises. That's Wall Street's guidance for 2016. Market experts say while riskier assets will outperform, investors need to decrease their expectations for returns and raise their appetite for volatility.
A lot of our clients, they look towards things that they can kind of believe in on a multi-year basis when equity markets are volatile, and we expect they're going to continue to be volatile. And there we look at things that are related to demographics. You know, the aging population in the Western nations has ramifications both for their societies and for the way global trade flows around the world. We're seeing the population of the world move to the east and to the south. At the same time, we're all affected by things. I mentioned cancer before, and this is one of the long-term themes that we're playing is as the benefits from all the things we've learned about genomic research and all the new biochemistry advances that have taken place, how they're now really starting to come together and create some new cures. So that's an exciting long-term theme that many of our investors are looking at.
Some analysts say another reason 2016 will be challenging is investors will be adjusting from almost a decade of super low interest rates in the United States to an environment of gradual rate hikes. This is causing caution about certain sectors affected by the dollar and the trajectory of interest rates.
We would avoid the energy and material sectors because we still think that they're going to get hurt by a strengthening dollar as the Fed does go through its rate tightening program. We also believe that utilities should not do very well because they are a bond proxy with their high interest rates. And as a result, should rates be going higher, like a seesaw, could end up pushing down prices. We continue to be favorable on consumer discretionary because we are optimistic about the consumer themselves. Also, consumer discretionary has a pretty low international exposure relative to the market as a whole. We think that healthcare will do well this year. It's currently trading at a discount to the market's multiple. And then finally, telecom we think should do well because of recent acquisitions adding to the overall earnings picture.
Other sectors like tech and biotech will continue to be both risky but deliver returns.
Biotech has been crazy, and there's been a lot of money chasing it, but there are some real very interesting pockets in there that we think are worth pursuing. One is oncology. Cancer is now the leading cause of death around the world. Spending on cancer treatments is going up, but what's most exciting are these new immunotherapies, which are promising new cures even for some difficult cancers where there was no hope in the past.
Despite the outlook for more uncertainty and volatility, most experts level on patience from market highs and lows, opportunity does exist for all investors. Chitra Nabad for TRT World.
Now, you may recall that earlier in the week we spoke about the record year it's been for mergers and acquisitions. 2015 saw some $4.5 trillion worth of deals. And while most were in the US or Europe, Asia is catching up fast. It surpassed the $1 trillion mark for the first time ever this year. As Tara Joseph explains, China's massive company buying spree has been driving the force.
If you don't have it in-house, buy it. Chinese companies have been on an overseas spending spree in 2015, fueling a record year for deals in Asia Pacific. Mergers and acquisitions topping the $1 trillion mark for the first time ever. And it looks like there are still many more checks to be written.
Investment bankers are licking their lips at the prospect of another surge in M&A activity in the year 2016. It's a rare sweet spot in an industry plagued by job cuts and change.
Topping the list for Chinese buy-ups in 2015, tech deals. Firms spending big on cutting-edge products to boost manufacturing and cut pollution. Beijing also keen to cut in on the highly competitive microchip market, backing a deal worth nearly $50 billion to make the state-run Tsinghua Unigroup the world's third largest chip maker. Another big one, China's National Chemical Corporation splashing out nearly $8 billion for a stake in Italian tire maker Pirelli, the largest ever European purchase for a Chinese firm. China's push abroad is part of the government's plan to go global. It wants to build multinationals that can compete both at home and abroad as a way to balance out the slowing economy. But beyond growth, there's also the matter of status. Beijing determined to leave its mark on the worldwide business stage, as well as the political arena.
Well, for more on China, we're back with Nick Beecroft of HP Economics. Nick, China obviously really has been the hot topic of 2050. We've certainly discussed it with you countless times. We've seen the Chinese authorities doing an awful lot to try and stimulate the economy, devaluation of the yuan, more easy monetary policy. How successful do you think that they've really been, though, in trying to get the economy back on track?
Well, I think it's all part of an evolving process, and in a sense, the jury's out. We have to take a longer time frame to assess what happens to the Chinese economy. But I think all that should have been done probably has been, including the first nascent signs of the creation of a social security safety net, which may contribute very much to the desire of the Chinese authorities to have consumers spend more money rather than stuffing it under the mattress, so to speak, and saving for retirement. So I think that's a very significant development. Monetary policy, fiscal policy, all being used, plenty of space to do that as well, and some more. And I think although 2016 will show disappointing headline growth, maybe as low as 6.3%, which actually be the lowest since 1987, the process will continue. I think there could well be more devaluation of the yuan throughout the year. Devaluation is all such an emotive word. It sounds like it's going to be 15 or 20% when I use that word. I don't think that. I think against the dollar, very possibly 5-6%, something of that nature. And it was interesting the way they rebalanced their currency policy recently to a trade-weighted consideration of same. So all these measures will continue, but low growth, I think, in this rebalancing towards consumption.
So let's broaden that out a little bit. Look at other emerging markets that have had a bit of a tricky year. Which ones do you think are particularly vulnerable, shall we say, as we head into 2016?
Yeah, I think fundamentally speaking, Brazil and South Africa spring to mind there as being vulnerable due to exposure to declining commodity prices and special local problems, especially in the case of Brazil. And then again in South Africa, given the turmoil we've recently had over the appointment of the new finance minister. Turkey also springs to mind, probably a little harshly because the fundamentals are not too bad, but Turkey does tend tend to display, as, if you like, a high beta to problems in other emerging markets and to suffer from contagion in that respect. So the currency could be under pressure, for instance, again. Yeah.
Okay, just quickly, lastly, before we let you go for the year, if we look ahead to next year, two really big events happening stateside and here in the UK. We've got the referendum here and, of course, the presidential elections in the United States. How risky do you think these two events are for the economies?
I don't see a great risk from the presidential elections, really. I think the checks and balances in US politics mean that it's quite difficult for anybody to be too extreme in the measures they try and implement, setting aside, if you like, extremists getting into the White House, which I think is unlikely. So I'm not too concerned about the US elections. The EU referendum in the UK, yes, it's true. It may knock, let's say, 0.25% to 0.5% off growth because of the uncertainty that it causes. So let's get it out of the way as quickly as possible, hopefully in 2016.
So, and which way do you see that going?
I think in the end we will narrowly vote to stay in when the referendum comes around.
And any dip that we do see in GDP, do you think that would be something that could be long-lasting for us here in the UK?
No, I don't think so. I think structurally we're in good shape. But the thing that really worries me is that this is a very unbalanced world. You have the US and the UK looking pretty good. Hardly stellar growth. It's something of the order of 2.5%, but pretty good compared to real problems in parts of the emerging markets, the commodity price collapse. It's unbalanced. It's unbalanced in the fact we have rates going up in the US and maybe still going down in Germany. And those, if you like, contrasts in interest rate policies have led to huge problems in the past, such as the 1987 stock market crash. It was the other way around then. The US were lowering rates and Germany was raising. But the imbalance worries me a little.
All right, Nick, many thanks. We'll leave it there.
Okay.
Now, you may have noticed it's been quite a year for the movie industry, from James Bond's Spectre to the latest Star Wars and The Hunger Games. Box office receipts looked healthier than ever. Not only that, but the pipeline of movies in the making for release next year is looking pretty strong too. Bobby Rebell reports.
The 2015 box office will be one for the record books. According to Rentrack, North America is on pace to hit $11 billion in box office sales this year. They expect $40 billion worldwide. The biggest blockbuster, Star Wars: The Force Awakens, hit $1 billion at a record pace and hasn't even opened in China yet. The phenomenal performance is even more impressive given the high-quality content on the small screen in places like Netflix and Amazon. Rentrack's Paul Dergarabedian.
So even though there's all this competition, the reason we're getting to a record year is, yes, of course, ticket prices are higher, but look at how much more competitive the marketplace is today and how many options people have for entertainment. And the fact that that old-fashioned idea, going to a movie theater, sitting in that communal environment, having a great time with a lot of other people outside of the home, it still is viable and relevant as ever.
Dergarabedian says 2016 is looking strong as well, with big hits expected including the new Batman movie and the latest Captain America.
Well, to South Korea now, and paternity leave is a pretty novel idea in Asia, only having been introduced fairly recently in South Korea. And it's changing the life-work balance there pretty dramatically. More and more South Korean fathers are turning tradition on its head and taking advantage of paternity leave to help raise their children. Julie Notche has been following the development.
Chung Sang-hoon is doing something not many men do in South Korea. He's taking care of his children. The 34-year-old is amongst a growing rank of fathers known as super dads because they're so rare, who are taking paternity leave to care for their children. Chung says he's trying to break tradition. I want to be different from my father's generation, he says. Deeply ingrained social stereotypes still see South Korean women taking on the majority of housework and childcare, despite also having full-time jobs. Government incentives are trying to change that. For example, mothers and fathers are each allowed up to 1 year of paternity leave, which can be used at any time until the child is 9 years old. And then there's this, a popular reality TV show that features male celebrities taking care of their kids. Chung's wife, Chung Mi, who's returned to her teaching job after taking 1 year off, says her husband's help relieves some of her mommy guilt.
I can work without feeling pressure. I don't have to worry about home. I do not have to go home early. And I do not need to feel sorry for my kids when I go to work in the morning.
Last year, only 3,400 dads took advantage of the paternity leave.
Well, that is almost it, but before we let you go, here are some of today's top stories. Microsoft says it will warn service users when they suspect a government has tried to hack their accounts. The policy shift follows similar moves by Facebook and Twitter. Shares in Weight Watchers soared some 19% after the company launched an advertising campaign featuring Oprah Winfrey. The TV host talked of her battle with her weight during the emotional 1-minute ad, which was shown in the US on Wednesday. Winfrey bought a $43 million stake in the company back in October. And it has been a stellar year for Hollywood, with film ticket sales on course to break records and hit $40 billion worldwide at the box office. Well, that is it for now, but we will, of course, be back later in the day with the top business stories making headlines around the world. I'm Kimberly Lim, and you've been watching Money Matters.